welcome. For today's interaction, I'm joined by my colleague Chirag, and we have with us Ashutosh Bhargava, Fund Manager and Head of Equity Research at Nippon India Mutual Fund. Welcome, Ashutosh, and thank you for taking the time for this interaction.
Thank you. Thanks for having me.
Ashutosh, you started working with Reliance in 2008. And so how do you remember that period of global financial crisis? What are your memories of those days like?
Yeah, so it was a tough environment to say the least. Just before the GFC, we thought markets can only go up. There was people perhaps had forgotten the a very basic concept that markets are cyclical, and come 2008, we realized that there's never different anytime. So it's always cycles always prevail. Risk management is a virtue. Leverage is a double-edged sword. More importantly, what I realized, because it was a very brutal 10 odd months of bear market, that fear is a very, very strong emotion to encounter. But if you can be patient and you reach the other side safely, there's tons of money to be made on the other side. So the virtue of being more patient, be more systematic, try to keep being more level-headed. I think these were the virtues. And, again, time and again, we have seen, even after GFC, there have been periods where this kind of volatility that we have encountered. So those learnings have definitely helped.
Ashutosh, another thing was you manage one of the top 4 schemes at the fund house. So how do you manage this? How do you manage it? Very large funds and managing a team of analysts.
So I'm blessed to have that kind of opportunity to manage the whole team on the research side, but also contribute whatever learnings I have had over the last 18 years. In terms of the funds where I'm involved. So, at the end of the day, most of our investments rely on the research, and research is the backbone of our investment team. And once you manage the team, interact with all the analysts who are experts in their own domain, that learning definitely helps in terms of expressing those ideas and learnings into the various funds that I co-manage. So we are being more bottom-up in our approach, and certainly, having a dual role acts as a more of a complementary kind of thing, where learning from research helps in fund management, and having one leg in the shoe of fund manager ensures that we understand, what are the gaps in the research which we need to correct over time. So it's a role which I definitely enjoy.
Ashutosh, just wanted to understand, what is the framework of your research framework at the fund house, and how big is your research team at Nippon India Mutual Fund?
So in terms of style, we don't marry to a particular style. So ours is more balanced in the approach. So we are neither too much on the growth side of the spectrum, nor too much tilted towards value investing style. So ours is, if I may say, in a more cliched term, more GARP kind of investing. And this is what we encourage at a research level as well. So we cover more than 470 stocks. We have a large 15-member research team. We don't have any concept of soft coverage. So this is a very, very experienced team, and the kind of detailing we do across our companies is also pretty huge. And in terms of approach, the approach is very simple. We need to identify right sectors, right companies, wherein we look at factors like size of the opportunity, competitive environment, management quality, governance, and a lot of focus on numbers and being right on estimate, both from P&L and cash flow perspective. So approach remains very simple. Be thorough in terms of numbers, but having a medium to long-term time frame, and don't get swayed by shorter term volatilities, what the message we give to our research team members.
Right. Now, can you describe your overall investment philosophy and approach to managing equity portfolios specifically?
So as I said, ours is a more evidence-based kind of investment style. We are typically what style people talk about. We are style agnostic in that sense. We rely a lot on data and insights to identify stocks, and we focus more on growth and earnings rather than only the valuation. So for us, it is growth first, and obviously valuations are important, but growth and quality of growth, comes much before the valuations for us. So this is a broad framework. As far as how we go about doing that, obviously we look at respective sectors which will have their own driving principles. So broadly, it all remains the same: the total addressable markets, the competitive intensity in the sector. Then we obviously look at the edge or most that individual companies would have, managerial competence, governance, etc. And particularly in the smaller companies, we also have a greater emphasis on management quality. Not that we don't look at in large cap, but definitely in a small cap stock research framework, management quality, vision, competence. I think this is where we give slightly more emphasis. So mix of everything, but more focus on bottom up rather than top down, more evidence based, and we give enough freedom to everyone to express themselves, because every sector would have its own nuances. So no one size fit all, but basic framework and approach remains the same.
All right. And for the benefit of our viewers, how big is your investment universe?
So as I mentioned, we cover more than 470 stocks in our universe, out of which close to 240, 250 stocks would be small cap, and rest would be mid and large cap stocks.
So you explained your strategy at the fund house. So the next thing is, how and what stocks do you compel to buy on the portfolio?
Sure. So as I said, we would prefer to stock having a very strong tailwind. Obviously sectoral tailwind is always preferable. But however, it's not necessary, for any stock or set of stocks to come under our portfolio. Sector tailwinds improve the odds, but when we look at individual stock, we look at stock fundamentals. Both the earnings and the quality of earnings should be improving. We also, I personally rely a lot on some of the quantitative factor parameters, and I try to identify stocks, which are good on quality, growth, sentiment, other tailwinds, and obviously there has to be some price value gap. So valuation comes as a handy tool, but not the only tool. The combination of stock, ideally the best combinations are where the stock is also is coming in some kind of screening or quant framework as far as factor investing goes. And wherever analysis is also positive, I think that makes a very compelling case for entry of a stock to come in a portfolio. But at a broader team level, it is the faith in the research team members and the involvement of the senior fund managers to drive the whole investment research piece. I think the combined effort and the confidence that it brings in to the table, and the way we have devised our KPIs, where there is a very nice balance in terms of identifying and rewarding analysts for both short-term and long-term ideation. I think that helps. So it's a very holistic process. But the good thing here is that every fund manager is given a broad framework for fund casing, but within that framework, he or she is independently evaluating what stocks to come into the portfolio, depending upon the mandate and their own style preferences. And it goes without saying that research always remains the backbone for every fund manager as far as providing input from bottom up. stock picking perspective.
So you explained about the what are your analysis and then how the stock enter the portfolio. But can you just explain what are the stocks or what kind of stocks you never touch or stocks that never enter your portfolio?
So we look at three, four kind of risks, to be honest. We look at the business risk per se. So there are sectors and companies where we identify there are terminal growth risk problems. So they may not have a great future, more great addressable markets. So that becomes one of the criteria where we become less interested in evaluating those companies. But that is not alone. We also look at the governance quality. If there are red flags in governance, we don't even bring in our coverage universe. We also look at managerial competence, because not only the governance is important, but in a world with full of disruption and it's evolving very fast, we need to find management who are competent enough not only to maintain their market share, but also to gain market share and enter into new categories and increase the pie for us as shareholders. Last but definitely not the least is the capital allocation policy. Companies which are poor in terms of their capital allocation policy, they also kind of get excluded. So we have these three, four broad risk parameters, and if the companies on a holistic basis do not kind of clear those parameters, they are not a part of our coverage universe. And even if they are part of coverage universe, they rank pretty low in terms of preference as far as whole team's perspective is concerned.
Another thing was interesting thing was in the last 3 to 4 year markets have seen one side rally, and we have seen most of the retail investors coming into the markets, and they're investing into BOP stocks, what we call the buying at any price. That has been the scenario in the last 3 to 4 years. So what's your overall take on the buying at any price scenario?
No, we actually have encountered this kind of environment. So pre-COVID, if I recall right, we had that kind of environment where there was a lot of disregard for valuation in general. I'll be very honest here, there were at times that there was some performance pressure also into that, but we have always stuck to our broad framework, broad philosophy, and that is our GAR philosophy. So we have never overpaid in most of our portfolios. At a portfolio level, we have always focused on growth and quality of growth. And as I said, and I'm again repeating, we understand that overpaying definitely doesn't lead to superior medium to long-term performance. So that has always been a cornerstone of our investment philosophy over the last many years. And this in last 2-3 years, this has come very handy, because those high valuation stocks, which were having astronomical valuation without commensurate growth upside, they have been trailing those kind of stocks which were relatively cheaper, many a times more in a cyclical kind of sectors, where the growth is returning in those sectors. They have significantly outperformed the so-called BOP stocks that you talked about. So GARP or BOP or any other philosophy, value or deep value, etc., I think we stick to that broader philosophy across our funds.
But Ashutosh, just looking at the portfolio, there are few of the stocks, which are high multiple Ps in your portfolio. So how do you, justify that thing?
So when we construct a portfolio, when we look at the portfolio as a whole, we want to participate in all kinds of profit pools. Some of the profit pools, for example, in new age tech or some discretionary compounder companies in retail or other discretionary sectors, they may not be cheap. So they may be high PE companies. And our philosophy is valuations is not about any integer, PE ratio or PB ratio. Valuation is much broader than that. It's all about price value gap. So in a high growth company, if we think that against its own time, it is trading at a reasonable valuation and offers a significantly good upside in return ratio, at an individual level, we are happy to have those companies as compounder and long-term bets in the portfolio. But when you look at the same portfolio at an overall level, you will find it's pretty well diversified. It has a good mix of value plus these kind of companies which are called growth companies. At a portfolio level, typically our portfolios, multiples that people track in the form of PE ratio, etc., would not be much different from benchmark, in many cases actually lower than benchmark, despite the fact that most of our stocks would be such where 1 or 2 years growth visibility is on the is on the improving side. So individual level, yes, we are not averse to buying high growth, high valuation companies, but at a collective level, we are very cognizant of maintaining the right valuation at a portfolio level.
So any particular stock which you feel it has an upside, potential upside, you go and buy despite having a higher valuations.
Yes, as long as the STEM or the total addressable market, that opportunity is good. It has some kind of edge of pricing power. Its competitive environment is supportive. Managerial competence and governance level is at different level. And the capital allocation policies are also very good where they are generating good return ratios. If these are the quality which are available, we won't be shying away from having those kind of stocks in the portfolio just because the PE ratios are higher. So we are not fixated with that. So that's why I said we are neither truly a growth kind of fund house nor fixated with deep value. We are GARP investors. So growth comes first, and what we pay obviously comes handy in determining how we want to construct our portfolio at an aggregate level.
All right. Now, Ashutosh, how will you define yourself as an investor? As what kind of situations or what kind of stocks excite you?
To be honest, my personal style is more evidence-based. I'm more data-driven. My interest also lies in looking at these quantitative, fundamental, and technical factors. So, for example, I run a quant fund where I look at various parameters like growth, quality, value, momentum, sentiment, and I try to identify companies which are ticking most of the boxes. So it's a diversified approach. It's a very thick model, which I call it, not relying on 1 or 2 parameters. And more evidence if I get about a particular sector or set of stocks, this is where they come at the top of my preference. So again, if they are also kind of combined with the views of our internal research team analysts, that gives me a lot more confidence to add those stocks in the portfolio. So bit of mix of quant data, as well as getting a bottom-up support from a team level, and that makes it a more hybrid kind of a multi-factor kind of investment approach. At a personal level, I enjoy doing that.
All right. And how often do you face a situation when research points to a sell, but as a fund manager, you see it as an opportunity? How do you deal with such situations?
It often happens, that research point of view could be different from what a fund manager like us would perceive from at any particular time frame. And I think these conflicts are fine and acceptable as long as the two things are there, that research efforts are from medium to longer term perspective, and we encourage research team to have this independent view. What we do if these conflicts arise, we sit down, we have very high interactive research and fund management environment. So collectively, we try to iron out the differences in opinion. But even if the differences remains, and for us, what is also important at fund management level, we have our mandates, we have our fund casing. Many a times, we are also compelled to have stocks which are different from our research team views. But we have to also manage and maintain those fund casing and mandate requirements. We can differ. So we are fine. We accept those differences as long as those differences are 10, 20, 25% and kind of contained at that level. More and more, we want the convergence on research to happen, but we are not fixated to have this number at 100% kind of group thing at a team level. So we are in that way, we are more of an evolved team, and we understand it's a continuous process and journey where independence of thought is very much appreciated.
So another thing was we looked at the Nippon India multi-cap fund, and then we found several stocks, more than dozen of stocks in the portfolio for the past 10 years or so. So just wanted to understand, don't you have a price target which prompts you to sell?
Not about price target. It is about the companies if they are delivering and they are delivering on a continuous basis. Just because stock has run up, we don't necessarily exit. As I said, we take decisive call in this particular fund. For example, I along with the senior fund manager, we take decisive call on 2 or 3 themes, and these themes are not for 1 or 2, 3, 4 quarters. They are for multi-year perspective. And if we believe in those themes, even a stock has slightly run up ahead of its time from a shorter term time frame basis, we would adjust the weights here and there, but we would keep holding the good companies, great management, as long as we understand the thesis behind it, the improvement these companies are doing, and we think that they're still broadly well within the realms of what we want to pay for those kind of businesses. So the churning is something which is not unnecessary from our perspective. It's not that we buy stock and we forget about it. The evaluation process is a very continuous process, but we won't shy away of keeping stock for 5, 10, even 15 years, as long as those stocks and management continue to deliver and surprise us and the market on a positive side.
Are there any stocks which you kept for 15 years or more in the portfolio?
There are few stocks which we have been keeping for more than 10 years. 15 years, I don't think so, but definitely there are many stocks which we have for 10 years or more.
So when do you sell a stock particular?
So obviously, selling is also is a function of few things. So for example, if the stock that we have bought, if it is in a cyclical stock and we believe that cycle is going to turn adverse, that is the time we have to really think about exiting those stocks, right? So in a cyclical stock, selling becomes equally important, and all. Obviously, if we find valuations being so high that we cannot justify with the current cash flow and the foreseeable cash flows, or a complete no would be if we find something which crosses to the boundary of suspicion as far as management quality, governance, etc. is concerned. That's where these come as potential sell ideas. And obviously, as I said, research is very, very important piece for us. So if a research team has compelling arguments and they have opportunities which are better than what we existingly holding in our portfolios, that also becomes one of the reasons why we would trim or exit a particular position, because we would have to create space for a better risk reward opportunity in our portfolio. So multiple reasons, no one particular reason, but valuation would only be one of them in my view.
Ashutosh, while we spoke about, you are having a few of the stocks for a decade or so, but in the portfolio, I also saw there are few stocks which are there for brief period, for 2 months, 3 months, or 4 months. So when does this kind of thing happen in the portfolio?
Typically, this kind of thing doesn't happen. So, orientation would always be for the medium to long term. But many a times it so happens that the stock run-ups are fast, or we identify some problems. Initial thesis, we start buying something, but we encounter some issue which compels us to revisit our thesis, original thesis. So that's where we start trimming positions, which perhaps we would have bought few quarters ago. Similarly, this stock in a cyclical sector, for example, or something which is at a team level, we know this portion of the portfolio we will always manage from a tactical standpoint, and those tactical opportunity get kind of realized in a shorter term time frame. We move on to look for better risk reward opportunity. So we are not averse to churning. Certain portion of the portfolio would always be such, but at a broader level, there will be the churning would be well contained as per the mandates, and most of the stocks would be bought at least from the medium to long term mindset. The core of the portfolio would be from that mindset. The tactical ideas could be 10-20% and not more than that in overall scheme of things across portfolios.
So this tactical idea, you can come in or go fast, exit the stocks.
On a relative basis, it is possible. As I said, these are typically in those sectoral cyclical opportunity where cycle from brief time frame becomes more favorable, and that's why we want to harvest that alpha also. But as I said, they may not be a big part of our overall portfolio.
All right. You manage some pretty big funds. So is size a problem?
It's all about the context. So yes, size is perceived to be the enemy of return. So there's some element to it, that maneuverability gets compromised with size. But at the same time, it's a journey. So once you reach there, you have to make certain tweakings. You have to start identifying opportunities bit early, and you have to, back of your mind, you have to take that thing into account that there will be some impact cost when you enter or exit a particular position. So with size, those constraint definitely comes in. But this is not a new problem for us, and any institution, and most of the institution which are even our peer group, would face these kind of compulsions and adjust the strategies marginally here and there. But the fundamental would always remain the same. You buy good businesses, be in the right themes, stay invested for long term. And if you do these basics right, then I think size would be one of the criteria for your medium to long term portfolio success, and may not, make or break factor as such.
All right. And what do you do differently in managing the multi-cap, large cap, and your tax saving fund?
So these are the funds, obviously I co-manage with different fund managers, and these individual categories have their own mandates. Some of the mandates like multi-cap, we have to really focus more on the bottom up side because there will be more mid cap and small cap exposure. So in the large cap fund, sector selection becomes slightly more important, while stock selection bottom up always remain important element, but allocation effect becomes more important. Large cap, when multi cap or tax fund where the canvas or the universe is much bigger, there the focus more on bottom up, taking more and more research input, doing more groundwork on our own. That becomes a slightly different criteria. But more importantly, we are all governed by our own fund casings. These fund casings are great guiding rules. And the research input, the research team remain the same. Organization philosophy of risk management, etc., that remains the same. But managing money with different fund managers and different team members, obviously different people would come with different temperaments. So there is some bit of adjustment at a personal level that I have to do, and there is a great learning in these kind of partnerships. So there are adjustments, but as I said, basics remain the same. We want to identify good companies, great management, and think for a long term as far as overall portfolio orientation is concerned.
If we look at the large cap funds, they are unable to beat the benchmark or generate the alpha. So what is a strategy to generate the alpha and beat the benchmark for the Nippon India large cap fund?
I think it's a myth that large cap portfolios cannot beat the alpha. So yes, the weight of evidence is slightly against them. Typically, if you look at a large cap kind of universe, you realize that there's enough and more dispersion across different sectors, and within the sector, in different stocks that comprise of various sectors, there are enough dispersion available. There are enough price value gaps are available. There are enough overreaction, underreaction that keep taking place for fund managers to create that alpha. What we refrain from doing is to do that what people call it closet investing. So if you don't take deviation, if you don't take right risk, I don't think then you will be able to create alpha over and above the expenses and fees that you charge. So you take deviation in 3, 4 sectors where you have good insight, you have good conviction, and you take those meaningful deviation in these 3, 4 sectors in the overall risk management framework. And then you rely on the bottom up opportunities across sectors. So you have to take deviations, take advantage of the dispersion which are available on an annual basis. And as I said earlier, also in large cap in particular, you have to be right on both top down and bottom up. You can't rely only on bottom up. So some bit of extra effort as far as doing the right allocation, choosing the right sector, I think that becomes slightly more paramount versus other categories.
Right now, Ashutosh, Indian market is well researched now with increased institutionalization. So, how do you discover new ideas and opportunities ahead of others?
No, market is more research. There's no two ways about it. But at the end of the day, the opportunities of mispricing keep coming, but because the participants remains the same. So you keep getting opportunities where participants are overreacting on either side, either on the upside where they take the valuation to a very unreasonable level, or in a slightly difficult environment, something that we saw for many domestic oriented cyclical sectors and companies. Uh, Pre-COVID and around COVID, and that's where the mispricing happens. For example, in PSU companies, a lot of PSU companies, those opportunities mispricing were very, very serious for anyone to exploit. So I don't think that market being more research necessarily means that those behavioral aspect, the herd mentalities, I think that goes away. And at a organizational level, this is where the experience count, the process orientation counts to look for those mispricing on a continuous basis. And I don't think those that those edges, those competencies from fund management perspective, they are going to go away anytime with technology or more people, more research being more available. I think those behavioral edges will always remain. And I think these are the two edges, because information and talent is in abundance in the market now. What perhaps is missing is those right frameworks, long-term thinking, and those behavioral edges, which creates the difference in terms of organization which creates longer-term alpha and those who struggle to do so.
Ashutosh, another thing was, few of the Nippon India schemes have made, equity schemes have made a comeback. But they were inconsistent before that. So what have you done to address the issue?
So to be honest, it's a right kind of observation that there were more volatility in returns and the experience were relatively less smoother for our investor, say 5, 6 years back versus it is now. So today we have more broad-based, consistent performance across many of our funds. It's not that last 2, 3 years have been anything but easy, right? I mean, they were all very volatile kind of phases that we are all dealing with. Uncertainty remains as much as it has been any time in the past. What different we are doing now is that we have this framework called fund casing, where we are taking into account few of the time-tested principles, which makes the consistency the core of our overall investment philosophy. So we take the right risk, not too less, not too much. So we look at something like our active share very seriously. There are no deviations allowed in each of the funds active share that fund manager can take. We have focused significantly on our risk management framework. So each of the 470 stocks, we rate them on all kind of risk parameters, and that becomes the cornerstone of how we construct our portfolio. So lower rated stocks in our risk rating, there is a limit what a fund manager can buy in the portfolio. And those limits helps because we don't want alpha to come by going lower on the quality curve. And typically, this is a problem which happens in bull markets, that the fund managers start to go down on the liquidity curve or quality curve. we are very consciously avoiding those things, and we have embedded those factors in our fund casing frameworks. And the results are visible, it's been 3-4 years. Uh, it's been more than 5.5 years we are making those efforts. And 3 odd years, these benefits of those efforts have started to, kick in across our portfolio performance. So, and there has been a lot of emphasis and a lot of handholding and learning by our parent, so Nisai Asset Management. They also help us in terms of passing on their learning and experience, particularly on the risk management side. So style deviations, or individual sectoral tracking errors and active share. These are the things which, at a collective level, they are being tracked on a monthly basis. And if you follow those guiding principles, consistency is a definite outcome. And we think, that journey we are well ahead in that journey. And we are very well aware that, we have to not only address, and we have to ensure that the investor community consider us as a very responsible fund house, which focus a lot on the journey of our investor and the experience that they have with us in their long-term wealth creation journey.
You also manage asset allocation fund at the Nippon India Mutual Fund. So, and that has been demand for the past few years, kind of thing. Means many investors invest in this kind of fund, directly they get asset allocation across the equity and debt. What is the differentiating factor which you bring to the table at the Nippon India Mutual Fund for this asset allocation funds?
So I believe in more of a multi-factor approach as far as asset allocation is concerned. So we not only rely on typical buy low, sell high, valuation-driven strategies, we combine it with more of a macro behavioral factors as well. And we don't shy away from even including momentum factors, which some people would find it, not so intelligent way of doing asset allocation. We find value in a more diversified approach, and the 3 to 4 different asset allocation strategies that I manage. We ensure that we give the investors choice as far as the extent of diversification and dynamism that investor is looking for. Vis-a-vis, the trade-off which comes naturally with that, the complexity of the product. So, for example, in a multi-asset fund, we only talk about diversification in really uncorrelated asset classes like international equity, domestic equity, gold, and fixed income. And we don't run it in a big dynamic manner. It's more simple, not very complex, but it provides adequate amount of diversification and good risk adjusted return, which investors are looking for. But in certain other approaches like a balanced advantage fund or asset allocation, asset allocator FOF, we use our models to reduce our subjectivity, and we try to navigate, different market environment based on these time-tested, diversified models, which helps us in, being in equity and other asset classes in a rightful manner across different market cycles. So I've been doing it for more than 5 years now in different products, and now it is reasonably well settled and established. There has been a good learning curve for us, and again, we don't take side here in terms of being a pure play valuation driven asset allocation solution providers or a pure momentum driven solution providers. We believe in the diversification at an input or a model level, and that what differentiates us in terms of giving all kind of right products for different kind of audience, with different kind of likings for complexity vis-a-vis complexity and dynamism vis-a-vis those who are looking for simple plain diversification option. Those are also very well available with us.
You have been in the financial industry for the past over 2 decades. So could you share which were the which were the investment decision which you are really proud of in your long career of over 2 decades?
No, to be honest, that has been the learning. The biggest thing at an individual level or collectively at a team level is to stick with our conviction on the domestic demand-oriented stories. So we had a tough time between 2019 in particular and early part of 2020, where due to variety of reasons, pre-COVID, that the cyclical recovery could not take shape. We stuck to that belief that domestic demand is a bigger opportunity. Domestic cyclical sectors provide bigger risk reward versus those external sector opportunities. And that framework, that belief has really worked. And the result of that is that across our portfolios, large cap, multi cap, small cap, mid cap, that belief of individually and at a collective level has really played out. So getting the call on the cycle right and those segments right, that has really been a big kind of satisfying achievement, if we can say, at a collective level for us.
All right. And anything that you regret in your over 2-decade-long career?
Regret is a very strong word. So I would say it is more like learning, for us. So, and to be honest, we make our due share of mistakes almost all the time. So that's not something that we shy away from. We are in a business of probabilities. We go wrong many a time, but learning from the mistakes, not repeating them again and again, is something that systematically we imbibe, and at a collective level, many a times we don't realize, but that becomes a part of the whole process. So there have been many such learnings. So, for example, one of the very recent learning, for example, was that post-COVID, people would come back to the older habits. In certain categories, it happened with a vengeance. But in certain categories, we perhaps didn't realize that COVID has certainly changed some habits. For example, movie watching, for example, right? And it took time for people to really come back to the theater. So these are the learning, now people are now coming back, but it took good 2 years for people to come back to movie watching. But these are the learnings and beliefs that gets challenged from time to time. But then, as I said, there's never a point where we believe individually, collectively, that we have cracked any code. It's all a probabilistic game. And we have to have a full faith on the process and keep learning, keep making mistakes, minimize those mistakes, and keep, evolving ourselves.
All right, great. That's all for today. We hope our viewers benefit from the insights that you've shared. And Ashutosh, thank you for joining us and answering these questions. Thanks.
Thank you.
Thanks, Ruchira. Thanks, Shira. Thanks for having me.